wide divergence in performance, right? The reason for this is the foreign money. Now, why did the foreign money come? Why foreign money comes into large caps largely, right? Why did the foreign money come? Because in response to the COVID crisis, central banks in the developed markets reduce interest rates drastically. So if you see here right from 2000 to now, the interest rate chart, and look at 8 to 10, it was at around 1.75%, right? Today it is at 0.75. That is almost 100 basis points below that of the previous crisis. So obviously the government has taken a far stronger approach to cutting interest rates. So cheap money is available to FIIs to invest in any emerging market. Number one. Number two, quantity of money. One is the cheap money, second is the quantity. So $13 trillion of liquidity has been pumped just by the G4. Who's the G4? US, Europe, Japan, and UK. These four countries form the G4 countries, and they have pumped in $13 trillion of liquidity. And by December 22, in the next 2 years, double that is going to get printed. So quantity of money available in the world system to go to the right country is going to be ample. The third thing here is that India, as you can see, except for in the month of February, in the post-corona lockdown announcement period, there was a sharp outflow of money from India. But after that, as you can see, regularly, except for 1 month in the middle, money has been going up, right? So if you now look at this data, it shows you that Korea, Taiwan, Indonesia, Philippines, Thailand, India, and look at the bottommost line. FYTD means financial year to date, from April to now. CYTD means calendar year to date, January to now. Can you see? India is the only country for the calendar year, for the financial year, to get positive FI inflows. Every other emerging country listed here has only seen outflows. So why this preferential treatment to India? I told you the growth story, the V-shaped recovery in the short term and the structural positive in the long term. Plus, just one more factor is how much is this money is in rupees crores. So April to now, FIIs have invested 208,000 crores in the Indian stock market. Whereas mutual funds have actually been selling. They have sold 85,000. Why, you may wonder why they have a difference in view. They don't have a different view. It is just that the FIIs have been buying just a few 10 to 15 stocks whose valuations have been shooting up, and mutual funds are feeling happier to sell because they are diversified entities. They cannot put concentrated. They have a SEBI limit of 10% for each stock, and they anyway don't want to concentrate their portfolios. So they have been selling to the FIIs, and actual selling by mutual funds is much more to the FIIs. So because every 2 lakh crore that the FIIs have bought, somebody has sold in India. So mutual funds, LIC, all of these have been selling to them. But mutual funds have been buying mid and small caps. So that's why in the short run, you saw mid and small cap indexes matching the large cap, but they have been selling the stocks that the FIIs are buying, right? Another reason that mutual funds have been selling is because there are net redemptions from investors, older investors pulling out money. So they have also been meeting that demand, right? So now, why this FII money is coming in? I told you the economic story, but look at the implications of that from their perspective on the Nifty's EPS. This year, last year, year before, Nifty EPS is around 480 to 500. The next year, financial 21-22, when India is going to do double-digit GDP growth, we're expecting the Nifty EPS to be 677. So this sharp rise in the Nifty EPS is what has driven FII money into the large cap space. That's why over the last 2 years, the large cap returns have been 24%, right? The second thing from a valuation perspective. So the right-hand side graph, if you look at first, it tells you that the most highly valued market is the US, S&P 500 at blue, highest P ratio. Then you followed it by Europe and Japan, more or less close to each other. Then you have the emerging market. So clearly today, advanced countries are trading at a premium to emerging countries. Now you come to India and compare it to the advanced countries, that is the world at large, and to the developing. You can see that India in February went through a correction. So India is always at a premium to the world. So the attractiveness of India reflects in the premium that foreigners are willing to pay to invest in Indian stocks, right? Now that premium saw a sharp correction over the last 2 years, culminating in the premium this world we are actually going to discount. But even in emerging market, the premium corrected by 30%. So that's one of the reasons that from a longer term perspective, India, they always willing to give a premium. They saw the premium has corrected and find India to be attractive. That's why if you see the premium has gone back up. So second reason for them to come to India is relative valuations with other countries. India is looking attractive. Third thing is our own historical average. So the MSCI is an index management company like Bombay Stock Exchange. So their index, this is a large cap index. If you see in the PE ratio, compared to our long-term average, the black line, we are trading well above. So we are expensive if you take historically. But you go to the right-hand side, that's called the price to book value. The left is price to earnings, right is price to book. In the price to book, we are below. So what does this mean? See, price to earnings is nothing but stock price divided by the profit and loss. From the profit and loss account, the profit, correct? Price to book value is share price divided by the balance sheet total, which is your total book value, total net worth, right? Total land and building, plant and machinery. So there, India is trading below its average. Why? Because our capacity utilization has dropped. Now, why is that attractive for a foreigner? Because any rebound in growth, Indian economy companies don't need to invest in fresh capacity. So no interest cost, no depreciation cost. Straight, whatever they sell will go to their profits. So that's where India is attractive to a foreigner because they are looking at price to book, right? So that's the second. And in fact, the same is true on the mid cap index, where you see left is showing overvaluation, price to book is showing undervalue, and the same is true in the small cap index, where left is showing overvaluation, right is showing reasonable valuation. So foreigners are looking at India because India's capacity to produce, right, is much, much more. And the recent correction in the demand has actually made this now very attractive to make a fresh investment, right? So that's the FI story. So now when you look at the Sensex itself in terms of movements, the valuations are reasonable because after correcting, it has come back up. And in fact, today, if you see, as I was mentioning some time back, if you compare to December 17 peak, the large cap P ratio is actually expanded by 2.1, 17.8 to 19.9, whereas mid cap and small cap index have corrected from there. So a long way to go for the mid and small cap to reach the previous high. So today the mid cap and the small cap index are trading at about 11 to 14% discount, right? So from that perspective, right, if you now look at the fact that the Indian economy goes through cycles, and generally you can say that in a good cycle, which is phase one, phase three, right, the small cap does better than mid cap does better than large cap. But in phase two and phase four, which are bad economic times, the large caps does better. So now from March, we see that the beginnings of a new good cycle in the economy are beginning. That's where you see the correction, the bounce back. But please look at that number. Now, if you go to phase three, you'll see that small cap delivered 226% return, mid cap 192, large cap 60. That is in an economic boom, small cap and mid caps outperform large caps big time. Same if you see in phase one, if you can look at those numbers. But this phase five, right now, all are going together, which means the true Indian economic story is yet to reflect in the stock market. Right? As the economic story develops, you'll see that mid and small cap will start overtaking large caps over a period of the economic cycle. Right? It will not happen immediately, but you've got to keep and watch. You will see that when the cycle gets into a full strength, it will be the mid caps doing better than the large caps and the small caps doing better than the mid caps. But you've got to be patient and give it time. Right? So, and now when you then look at the earnings pattern, you can see here the overall market line, the quarter two, sales is negative because of the, what is the reason? Economy was 7% negative, overall market is 7% negative sales, right? GDP to sales correlation. But operating profit, which is EBITDA and profit after tax, both you can see that Indian stock market companies have managed the downturn much better than the non-stock market companies. They have passed on their costs. They had low input costs because crude prices dropped. They have low interest costs because banks have reduced the rates, and they have managed to cut their flab, lay off the unnecessary things, work from home, all those situations means that the profit after tax, and if you take this number without banks, it doesn't look as good, which means that it is banks which have benefited most in this quarter from the fact that RBI has given them a lot of money, RBI has given them very cheap money, and they have not had any NPA problems to worry about. So banks are the lead driver of earnings in this quarter. And whether you see it as large caps, mid caps, or small caps, same story is true. Profit without the banks is not as great as profits with the bank. So banks are the new fast track growth sector in the economy, right? And the other thing is that if you look at the earnings which people report compared to what the market expects, and when the earnings come better, they upgrade it. This gives you a clue as to which sector will do well, right? So if you look at it here, the next year, FY22 consensus grade, you can see that exporters, financials, global price takers, that is, those who take their price from global things like what? Like oil, like metals, London Metal Exchange price is taken in India. They are the ones which have seen the most rapid. Why? Because the world is also recovering. So those prices have started going up. And so these are the kind of sectors which will hold well for the future, right? So now, if you then now look at the sectors, you saw already the BSE small cap, mid cap, large cap index. Now just look at the sectoral index, right? The first line is the bank and financial services index, right? Then I'm shown the safety index, which is IT, tech, pharma, and some amount of consumption. Then bottom, I'm showing the riskier sectors where some consumption like auto, consumer durable are a bit riskier, and then your true risky sectors. Can you see the difference between small cap, mid cap, large cap for 3 years and now reflected here? What is negative from 3 years? The riskier sectors. What is happening in the 1 month period? You can see that the riskier sectors are growing at double digit compared to the safer sectors. So the market, the baton is being passed from a safety oriented approach to a riskier approach by all market participants. And the banking sector, 1 year which is negative is because post COVID, the fear of NPA brought down banking stocks. But you can see the 6 month, there's been a 40% bounce back in the bankings. So this gives you a clue as to how the market participants are viewing sectors, and so the mutual funds, how they will mix it up. So I will now just tell you that from Sundaram's perspective, this is the weight of indices in the NSE 500. So private banks, we are overweight. OW means overweight, we are positive. IT, we are neutral because the rise has happened and now it's a time. So the next to it, you can see the 1 year return and the 1 month return, which will corroborate what I'm saying. Oil and gas, NBFC, we are still underweight. FMCG, we are neutral. But automobile, we were overweight, we are neutral. Pharma, we are overweight, we are neutral. So to summarize our position, right, I will just now summarize the whole presentation in just these 2-3 slides. So just quickly, let's read through this. The disruption of the pandemic is well behind us. The V-shaped recovery is evident, witnessed across the data that's coming out on companies' earnings and beating the realizations. The monetary fiscal stimulus is working its way through. US uncertainty around election with a Biden win is now behind us. So it's a trade positive and it's supportive for India. India has always reformed and turned around during a crisis, and COVID has given Indian manufacturing this opportunity because of the global China plus one shift. RBI has been supportive and preemptive and given enough liquidity, and government is also directing its fiscal stance to push consumption, right? So agriculture in rural India have remained strong, relatively unaffected by the pandemic. Hence, we'll see rising rural spends and agri reforms support rural India. Employment has come back to pre-COVID levels, and India's growth also we expect revisions in the coming months. So rural India and the middle income urban consumer will be the segment of strength, right? And just that recovery will mean that the stress buildup in the banking system will ease. Yeah, our inflation curve has clearly peaked, and low corporate tax, low interest rates, ample liquidity, rekindling of reforms, and ease of doing business. And government is also announcing this PLI, Production Linked Incentive Scheme, electronics, textiles, they've announced it. And the China plus one shift will help India to get FDI flows. Global QE liquidity is yet to peak. I showed you, right? $29 billion, trillion dollars over the next 2 years. So investors will be pushed to take higher risk assets like India, and within India, the riskier sectors, right? So based on which our portfolio strategy clearly is increasing exposure to quality financials, consumer discretionary, building material, auto, In the quality financials, we look at large private sector banks and good quality NBFCs. To play the global recovery, we think agrochemicals, specialty chemicals, auto ancillary, and IT services are good. We see proper IT as a very constructive, more safe play, good balance sheet, and potential for cost savings. And on defenses, we remain positive, FMCG, pharma, but in very selective stocks. Why? Because we want to also take care of a risk of a second wave, which could happen in India, right? But overall, our position is captured there that we are looking for reasonable value with a growth focus, right? Thank you, friends, for listening to me. And now I am happy to open the floor for questions.
Thank you. Thank you, Mr. Sunil. I think very clearly elucidated a lot of interesting graphs and charts. I'm sure this is going to add a lot of confidence to people. So we have been receiving a lot of questions on WhatsApp rather than on the chat box.
Okay.
I don't know whether it's the comfort level, but anyway, we have been able to compile a few. And allow you to take a little bit more of water, a sip of water, so that you can get.
Yeah, now we can go ahead.
Yeah. So one of the questions that has been asked is that with respect to, you had mentioned briefly that it is possible that the RBI could even look at a rate cut in the, there's a possibility. But one of the participants has asked that we are seeing that the inflation in the recent times has been higher. So in light of the fact that the inflation has been higher, do you still foresee a rate cut happening, or is there a possibility RBI even slightly increases the rate to control the inflation?
So, two things here. So, I think that the inflation has been high because of the supply side constraints. So, there is a demand inflation and a supply inflation. RBI always worries about demand inflation because if you cut rates, then people will be tempted to buy more. But a supply side inflation is not something that interest rates can control it, right? So supply constriction led to this inflation. Now I'm expecting that in January, when the agricultural product comes in, food inflation will come down. Oil is expected to remain steady at around 45, 50, 55 range, right? So to me, I don't think there is a real fear of inflation. That's number one. Number two is that as long as demand is still negative. So Indian economy, while we are talking about a V-shaped recovery, we're still talking about negative GDP growth, which means negative demand growth. That is the growth in demand, while it's growing, is still, it's just that it's less negative than the previous year. So this V-shaped recovery makes a lot of people think that we are in a growth path. So RBI cannot hike rates until India comes to a true growth path, which is somewhere in the third quarter of next year. So RBI tries to balance growth with inflation, because in trying to cut interest rates and boost growth, if inflation goes, they'll try to control it. But I think we are far removed from that. But that being said, I think that question is very apt, because I am a contrarian in this. My other fellow participants in the market are not expecting a rate cut. I am a contrarian, and I think that the this governor and this RBI is very closely aligned to the government. Okay, so on the balance of growth versus inflation, they will tilt towards growth, is my belief. And I agree that the general market view is not for a rate cut. Okay, so let me first off say that this is Sunil Subramanian's view. Time will tell whether I was right or others. But I want to be honest with my thought process. I may be proved wrong, but I see that with agriculture, see, tomato prices have come down dramatically. Until the lockdown, I never went to buy tomatoes. Only now I know the tomato price. So I'm just saying this supply, and all of you know, Pongal is the harvest season, right? So when all of that comes, inflation cannot go up. The flood of agricultural commodities will bring down food, vegetable, all those prices. And I feel that RBI will be in a much more comfortable position. So even if there is no rate cut, at least the fear of rate hike is not there. That much I think we can take for granted.
Okay, so there is a small question that has come in sync with that. Do you still hold your view on the backdrop of huge borrowings by both the central government and especially the state government due to the shortage of GST collection and welfare measures?
Yes, so I think that that has already been factored in. And I said GST collections have started bouncing back. We have
Right.
come back to touch the 1 lakh crore mark. And I think that next fiscal, so the budget is a very crucial time to wait for, 1st February, right? Because I think that this year the government, because of the whole uncertainty, could not push through the disinvestment program at all. Whether it is Air India, whether it's LIC or it's BPCL, there's still only talk, or the 5G spectrum auction. So I think next year, one of the things is that government will be very serious about pushing through those, and that will bring down the borrowings of the government, number one. Second is, by providing incentives to the state government, the government has made sure that state government borrowing doesn't exceed 5%. So any state government which keeps its borrowing below 5% fiscal deficit, they are given certain benefits to that government as a positive incentive. So I think that will help to keep the state government. So I expect India fiscal deficit, central government to be about 6.5 and state to be at 5. So consolidated fiscal deficit about 11.5. But that is not a surprise. That is what World Bank has already expected for India. So while his is a concern, and it is that phenomenon that he refers to is called crowding out by the government of the private sector from borrowing. But I think there is adequate liquidity that RBI has provided that even if government borrows, the private sector will not get crowded out. So I think that's the reason I believe that government borrowing is not going to be a hindrance to RBI's rate policy.
So the next question is on currency. Do you think the RBI will continue to keep the rupee low or allow it to strengthen? And because there will be a positive impact on if the rupee stays low, it will be an impact on the IT. But if it hardens, at least the import impact will be much
So I
lesser.
think on the balance, RBI is more concerned about imported inflation than about supporting the exporters. Okay, so I think
Yes,
that inflation is always the number one enemy the RBI seeks to fight,
right.
right?
Yeah.
So
Mm,
crude oil, if they allow the rupee to weaken,
mm.
right, they are buying, they are sterilizing. That's why our
Still
foreign
less.
currency reserves are going up.
Yes,
And
going
in
up.
fact,
Yes.
US is worried about that. US
Mm.
feels that India, RBI is not doing correctly. So they have put us on that blacklist, in terms of
Correct.
that. So I
Yeah.
believe that RBI, because of the inflation part,
Hmm.
will continue to try to keep the imported inflation low by keeping the rupee stable.
Okay. Okay.
So that in
Okay.
the short run, because I don't think there's adequate money with RBI to buy dollars.
That's right. That's right. And the next is a very interesting question. Uh, I think it's more on leaning towards the debt side. So it says that a lot of welfare subsidy is hidden in Discoms and Food Corporation of India.
Yes.
So, and that's not getting reflected in the the government's balance sheet. So is there something that's going to happen that the government, if it releases, then it's going to have a negative impact on the debt market?
So I think that what he says is very true. There's a lot of these hidden numbers, but I'll tell you where it is. It's been hidden for a long time.
Okay.
It's been always there. And the government has always been innovative. So the oil, there, if you remember the oil bonds,
Yes, yes,
right?
yes,
So the
yes.
government always is very innovative in keeping off balance sheet items. And the
Okay.
World Bank knows it, the rating agencies know it. It's an
Mm.
open secret. So
Okay.
as long as the quantum of that open secret remains the historic level,
Level.
nobody is worried. If suddenly something happens to worsen it, and this government, if you notice, even during the severest crisis, they did not just give away money to people.
Correct. Correct.
So I think this government is very aware of the need to attract foreign capital. And so hence to attract foreign capital, they know the importance of our credit rating. And so since they know the importance of the credit rating, they are also careful not to do revenue expenditure and try to do reforms and capital expenditure. So as long as everybody knows that Shashikala
Mm.
was able to come out of the Bangalore jail and go back every day, it is open. Nobody worries about it. Right? So it's like I said, it's an open secret, right?
Okay. Okay.
So I agree with this point of view that there is a lot of this, that it's not as if other countries are immune to it. It is like they're everywhere in the system. It is a rot in the system. It is an open knowing that it is, and this government is not going about worsening it. So I think
Okay.
to that extent, I would say that I'm not unduly worried about that as an impact on the debt market, because the debt market always reflects the reality of the situation. Unlike an RBI policy or something else, nobody can influence the debt market. Whatever the yield that reflects, it reflects all these risks inherent in that.
Inherent. Okay, right. That's a very good thing. So the next question is, so you're saying that the celebration in stock market is because the bad news was not as bad, and therefore, and we, there's a lot of confidence that the earnings will ultimately catch up. Is there any rider to this statement that we'll have to be a little bit careful about?
Yeah, there are three riders here. So the first rider is a second wave. So if because of this, Diwali, Christmas, Pongal, this people start going out and coming out. If there is a second wave, that's the first rider. The second rider is the fact that liquidity needs to be continue to be available. So if for any reason the US changes its stance on liquidity, right, then this no amount of bad news being less bad than it was expected. If there is no money, then the market will react badly. So the money should be available. That's the second. The third risk is that the world comes back to growth faster than expected. So please listen to what I'm saying very carefully. Because if people say, oh, that's good only. No, it's not good for India. And I'll tell you why. Because India today is getting money at the cost of other emerging countries, because most other emerging countries are commodity intensive countries. And since the world recovery is not there, commodity prices are low, FIIs are saying India is not so dependent on commodity. In fact, India is a user of commodity, right? So Indian economy will definitely grow faster than others. But the moment the world comes back to growth path, then demand for commodity will shoot up. And then those markets which are today undervalued because of the commodity cycle will reverse. And a foreigner has no love for India. He will go wherever he gets a better expected return. So actually a world economic recovery happening fast will lead to FII flow. And all the pundits will say, what is this? India's economy numbers are better, but foreigners are selling. Why? At that time, you please remember what I said today.
That's a good one. That's a really good one. I think
there's something called I like to call it the joke. I already used Shagikala, so let me use one more lady, Mrs. Ambani. Who is Mrs. Ambani? Not the elder Ambani, younger Ambani. This is Tina Ambani.
Tina Ambani, yeah.
Why I'm saying that the Tina factor, there is no alternative to India today. But the moment an alternative comes, India will not be that attractive for incremental FII flows. So bear in mind, we are getting money because of the Tina factor today.
Yeah, I think with respect to attractiveness, it holds good for both the Tinas. So, okay. Then the next one is one of the very interesting perspectives that has been brought about is that the capacity to produce is very high because India's capacity has been underutilized for quite some time. Correct. It also means on the flip side that the capacity additions are not going to take for some more time. So the capital the investments, asset creations on the capital side is going to remain subdued for a longer time.
Yes. So I broadly agree with what he is saying. Only thing I would like to point out is that there are three segments of capital expenditure. Or actually 4 segments. So let me explain those 4. So the first segment is government capex. Right? So government, so that's why the budget is the most anticipated budget. Because when government builds roads, builds airports, builds waterways, the spillover demand for cement, steel, EPC contractors, construction companies, all of that which comes from government is step 1, which I think will start very soon because the government has to spend. And this government will spend on capex rather than on giveaway, free giveaway. So that's the first leg of capex. The second leg of capex is foreign capex, FDI. So it has nothing to do with Indian capacity utilization. The foreigner is going to look at India as a place to manufacture and export back to his country. So it is the capex which is going to come in. That has to be done by foreigners. There are few groups like Mahindras and Tatas who are making products in India for the foreign markets. But most of India's products, quality-wise, Indian manufacturers are not up to the mark. So a foreigner who is today manufacturing in China will want to use India as a manufacturing base and export back out of India, right? So that FDI driven capex, the government, as I explained in my presentation, low tax rate, ease of doing business, opening up FDI limits, licensing requirements. So all of these factors, I believe that in the next 12, 18, 24 months, you will